The reality of running a startup studio is it's super hard. We went through that whole journey, made a lot of mistakes, but also learned a lot. Our revenues were like doubling or tripling every year, but our profit was the same. Like, what? That's like a really bad business. One of the biggest mistakes we made when we were growing the consulting business was opening up too many offices. We basically built 9 companies. A studio for us is a team of about 8 to 10 people. I found the intellectual problem around corporate innovation super interesting because no one had an answer. Like, no execs, no MBAs, no professors. No one had a playbook of like, well, like if you do these 4 things, you'll get 50% of the value, or like it will help. No one had anything. And so I love the idea of kind of trying to get somewhere between the best of being the founder and best of being an investor. And that's where I see the startup studio model come in. You can't successfully or systematically build successful ventures within the constraints of a consultancy business. Now, COVID hit in 2020, which was tough for us because corporates were like, we're doing nothing. You can make money for your business, but the projects and the stuff you do will never make any real money. I need very large corporates. I need corporates with minimum $1 billion in revenues. We only invest in second or third time VC-backed founders. We do not syndicate with external VCs. The ethos of why we choose proven founders isn't just because we believe they get better investment returns, right? It's also because we don't want to get tied up. 30% of the cap table at exit, regardless of how much money has gone in over those 3 rounds, our capital side would get 25% and the corporate would get 25%.
We've hosted already 5 online conferences for venture studios, VCs, and family offices. And I'm inviting you to join our paid community called Venture Studio Family. If you are a venture studio founder or a representative or a manager of a venture studio, you want to learn the best practices and know how different venture studios operate. So you can find the best ways on how to attract founders, great founders to venture studios, or how to create successful companies with not superstar founders. You can learn how to fundraise into your studio fund, or into your startups created in the studio. You can learn how to create sustainable studio, which has cash flow and which can be not dependent on external venture capital. You can find the best ways to manage the studio if you join this community. So check the link, Venture Studio Family, in the description and join the community of about 30 venture studios. I have questions now.
Yeah, go for it.
First, can you explain what is a typical equity split when you build companies with corporates and when you attracted second-time founders? So what is a typical equity split and what is investments from you and from the corporate?
In our model, the first thing you need to understand is we do not syndicate with external VCs. So us and the corporate will invest together in every single round from incorporation through to an exit, assuming the exit is to the corporate, which is plan A for us. So plan A, which is 90% of our portfolio, is we start working with a corporate, we build them a business that they want. 5 years later, if it's successful, they buy it, we make our money and we leave. So for the first 5 years of that journey, it's funded over 3 rounds. The seed round is always the same. It changes on geography, but like in the UK, it's 600,000. In the US, it's a lot more. It's 1.5 million. But in Europe, it's about 700,000 euros in Germany, 750 in France. But anyway, but let's take about from UK. So in the UK, the initial round is 600. We will split that with the corporate, either 50-50 or 2/3 corporate, 1/3 us. The second round is a seed round, which is basically 1.5 million. Sometimes if the venture isn't doing very well, we might give them a little bit less, but we target 1.5 million. So they go 600, 1.5, and we would keep the same investment threshold. So 2/3, 1/3, or half. The third round is between 4 to 8 million. At that point, we tend not to have the firepower to do, we might do 2 million-ish, But generally, the corporate will then do in more like 2/3 at that stage. So if it's a 6 million round, they might do 4, we will do 2, just because we're a bit capital constrained. So we can't do like 4 million into one portfolio. But it's 4 to 8 million. Those 3 rounds, the first will be 12 months. The second is like 18 to 20 months. Then it's like 2 to 3 years. So when you add that up, that gets us to like the 5-year window of when the corporate would basically buy back. Mm-hmm. So that's how we fund it. Now, the way we structure the cap table is, because we know the corporate's going to be the buyer, we have a very clear value proposition to the founders, which is 30% of the cap table at exit, regardless of how much money's gone in over those 3 rounds. So typically that's split 12.5 to a CEO, 12.5 to a CTO, and a 5% ESOP to key employees. In some cases, we'll do it 15-15, and then we'll create a separate ESOP, which us and the corporate dilute. But generally, it's 30% of the cap table is for the founders in their team. Mm-hmm. That's guaranteed. It can be slightly higher, but that's fucking guaranteed. At exit, we don't talk about at front and dilution. And we can't do that because we're not setting priced rounds in the wild. Because it's a captive investment, we can't get a real market like pricing on that. So we need to design for the end state from the beginning. 30% to the founders, 20% to the studio that gave birth to it. If my studio created it, my team and I would get 20% slug. So 50% of the cap table at exit is for the studio and the founders. The remaining 50% is for the cash. And it's split pro rata purely based on how much money we put in versus the corporate. So if we matched the corporate euro for euro throughout all 3 rounds, we would get our fund, or like our capital side would get 25%, and the corporate would get 25%.
What is the source of money for paying salaries in Rainmaking Venture Builder? So is it those investments into the startups from both sides?
So when you say the salary, do you mean my team or the ventures team?
Your team of the studio getting 20%.
We raise money to cover my entire team's cost. We've got a dual structure. We've got an opco and then basically like a fund vehicle. Now, in the beginning, we just invested off our balance sheet to prove some track record. And the intention is to then like have multiple funds attached to the studio or group studios. But when you look at it from a business model perspective, there are 2 business models that operate in parallel. One, you've got the studio. So the studio, my burn rate is about $1 million a year, less than for my entire team. We'll generate, say, 4 ventures a year. So for £1 million, we get 4 times 20% equity stakes at exit. Great business. Fine, no problem. So raising money for the opco is based on that math. Then you raise capital, which is very different. You know, in our world, it's ideally into our fund, which then basically says, okay, the money invests pari passu only on a deal-by-deal basis alongside Fortune 500s who are always co-investing, where the investment materials have passed an investment committee at our fund level. So it's a separate team. So I don't get to say whether we put money into the ventures I create. I create a venture or I have a venture and I go, cool, here's all the materials. I want you to put money into this. And a separate investment committee says yes or no. So there's governance there.
It's completely separate from the studio. Yeah, so you raise it or not, your studio?
We've actually struggled to raise our latest fund. This year's been really tough for us. So we've not managed to raise the fund we wanted to raise this year because it's just been market conditions have been terrible. But basically, yeah, it's separate. So the decisions around deployment of capital are different beings. And the people who run the way I think about it is there's the opco and then the capital co. The capital co is a different team that focuses on how do they get more money to deploy alongside corporates into the deal flow that the opco creates. And it's very different skill sets. So this is like your VC asset manager. They don't fucking know how to build a startup from scratch and how to sign corporates and convince them what to do, how to select founders. It's like they're asset managers. It's about investor relationships, raising money, LP techs, regulated entities, and the governance around good investment decisions or not. Very simple. But those 2 things are connected. So like the capital co, whether it's a fund entity or a separate entity, is managed as a separate entity. and it invests into the deal flow coming out of the studio. But it gets its 2 and 20. Its team is incentivized by its business model, and there are two business models that work in connection.
I thought that it goes to the venture builder, or it is like it goes to a separate entity. But you have shares in both.
Yeah, we kind of do. So we're both the GP. It doesn't have to be that way, but we happen to, yeah. But it's a separate team. So, and it's got its own entity, right? It's a regulated fund structure.
Is your venture studio benefiting from this fund? You have money to co-invest, and it's much easier to agree with the corporate that like we are co-investing, right? What is the additional benefits from having the fund?
If we didn't co-invest cash alongside the corporate, I don't think we could do what we do. Because also you have to think about the fundamentals. How do you align incentives, right? My biggest learning as an entrepreneur, just as a business person my entire life, is what you incentivize are the behaviors you get, period, regardless of skill set. I'll give you a good example. If I take an amazing founder and I ask them to basically build a startup, but I put them on a high day rate and I just pay them per day, guess what? They don't fucking behave like a founder. They're terrible entrepreneurs. Yet they've been amazing entrepreneurs, but they don't behave like a founder because I'm paying them a day rate. If you want a founder to behave like a founder, you have to put them on a low base salary and equity from day one. And they need to be focused on enterprise value creation. And that's where their wealth comes from. And they need to have opportunity cost in the sense that they're getting a salary, it pays rent, maybe they go on a couple of holidays a year, but it's not good enough, right? To be like, oh, I'll just stick around. So if the business is good, but it's not great, they're going to be the first one to be like, I've tried, it's just not working. I'm going to kill it because they've got opportunity cost and you want them to do that. So you need to have skin in the game and you need to focus on enterprise value creation, all stakeholders. So for the corporate, they need to put cash in. We need to put cash in. The founders give up opportunity cost and all of us get equity and we either win together or we lose together, period. No one's charging anyone any fees. No one's making money any other way than if this business sells or it doesn't, period. You have to align incentives. It's probably the most important thing you do in any task that you want to happen. That I think is fundamentally important. The other thing around it for us is we always act as the lead investor. Now, for corporates, doing this stuff is inherently uncertain for them. They don't know when something is so early or it's just an idea or it's only 2 years old, like, is 2 million revenue okay or is that shit? Are these KPIs like okay or is that like terrible? They don't, why would they, right? They're not VCs. So the key thing around it is if we go, look, we're going to our independent investment committee, they say, yes, I'm willing to put in 500,000, you put in 1 million. They suddenly go, well, if you're putting your money in, sure, we'll follow you. It changes the entire conversation. If I don't put any money in, they have to try and make this decision by themselves. That's going to be terrible, because they're fucking idiots. So you need to be the lead investor to show them. But also, I believe that if you want to make really good investment decisions, you always need to syndicate. So if they don't see it and we think it's a good idea, and they say no, why are they saying no? That's probably we should probably be mindful of that, right? So all good investors like to syndicate. Now, we're not syndicating to the level that exists in startups in the wild with multiple VCs per round. I think syndication is critical. The other thing is when you're a studio operator, every business you create is your baby. Inherently, if you're going to allocate resource to something, you believe in it. Otherwise, you're an idiot, right? So you really believe that has potential, can do something. And you hire the founders and you like them and you start doing stuff. And it's difficult for you to make an objective decision because you're so close. It's very different to being a normal VC because a normal VC, the distance from you to that baby, it's like you're not even a grandparent. You're like, it's nothing to do with me. And so you can be more objective of whether you should give them money or not. As a studio, you're a grandparent. You might not be the parent, the founders are more the parent on a day-to-day basis, but you're so connected emotionally. It's hard for you to kind of make objective decisions and kill stuff when it's a weed and not a flower. You kind of think, oh, we can turn it around. It's just, a couple more months. It's gonna work out. And so I really believe that having an investment committee that is separate and is distanced from the studio itself leads to better investment decisions at every round. So it's a conscious choice of why we've designed it that way.
How you launched new regions for your consulting business. Do you have now your consulting business in the UK also?
The consulting business operates in Europe and the Middle East now. We sold the Asia business to Boeing. So we're no longer in Asia. But the European consulting business, separate company, run by a guy called Phil, and then Abe runs the Middle East business. But yeah, they both operate. For us, in terms of geographies, we started in Europe. One of the biggest mistakes we made when we were growing the consulting business was opening up too many offices. I think the different thing for us was we had loads of corporates. So we were scaling Startup Bootcamp. And when we were scaling Startup Bootcamp, it was like, okay, FinTech London, FinTech New York, let's do FinTech, FinTech Asia. So we'll do FinTech Mumbai, FinTech Singapore. And we're getting local corporates to do that and would help people locally who wanted to run the accelerator program, help us onboard these corporates, and they might become the MD of the program or whatever. And that was very easy. And it was just like everyone wanted accelerator programs, right? You had like product market fit, it was kind of booming. And then all of those corporates were kind of the people we just sold to. We could sell pretty much globally from like a team of like 3 people. It was like, oh, we've got a client in the Nordics. We just sold a client in the UK. And then it was like, shit, how do we deliver it? And we kind of got excited by loads of different countries because we were like, oh, it's cool to open up an office. So I was like, oh, I love Asia. Let's open up Singapore. And then it's like, create an office. We just signed a massive contract in Malaysia with the government. Like, let's do an office in Kuala Lumpur. Let's do that. And so we did that. The mistake was you spun up all these offices and they didn't have critical mass of people. So you'd end up like 5 people, 8 people, but they wouldn't be like 30, 40, 50. And you also had this difficulty where there are a few people who can sell really well, and then there are a different set of people who deliver really well. If I could go back and build our consulting business again, I'd focus much more on just getting through, like, all agencies, at least in our experience, you struggle to get beyond a certain glass ceiling. You get to like, I don't know, 20, 30, 40 people, and then you struggle to get to like 50 or 100. So you basically get to a certain revenue number where you struggle to like break through that and stay consistent. So getting to like, 20, 30 million of rev consistently is like quite hard, actually. You can kind of operate it much smaller. And so we had these tiny little things that were sort of operating at like really inefficiently in loads of different parts of the world. But at some point you go, I want to scale it, I want to grow it. And then you realize you actually need to solve this problem of how do you get a dedicated team that can consistently sell work at the right price to then grow it and get through this point where you can kind of get to more like 50 plus employees, like 100 employees, and meaningful revenues, and also maintain profitability. Because one of the downsides with all consultancy businesses is your sales tend to be sinusoidal. So you have literally a few people who can actually sell. It's just like the partners, basically, who can convince corporates to give you like money. And so you sell. Those individuals have sold. Then they're delivering the work they've sold. So they stop selling because they're delivering. And then the revenue comes down. And they say, oh my God, we haven't got anything. We need to sell again. So you have this like sinusoidal element. And because there's no recurring revenue stream, you don't have like a SaaS or a retainer, there's no way to smooth that curve out. It's just the way it is. So the question then comes, how do I increase the amplitude? Because that's how much money, like we're making 5 million, how do I get to 20 million? I can try and find more people who can sell. That's really hard because the people who can really sell well tend to be running their own consultancy, or they're in a big consultancy and you can't afford it. So it's like, it's really hard. We found it really hard to hire people who can then just sell efficiently. So it's hard to just be like, I'll hire like partners who can just sell. So the most thing what you end up doing is basically just increasing your prices. You always end up going to like, you might start with a few small, medium businesses. You will end up serving the world's largest companies. and you try to price to what McKinsey does. Ultimately, you get stuck in this world of pricing to time and materials, and you struggle to price to value, and no one will pay you more than what a senior partner in McKinsey gets paid. So like a senior partner in McKinsey might get paid $10,000 a day. No one's fucking paying you that because you don't have their brand name. But that's what you're trying to do. You're trying to basically, because whether you sell a $50,000 project or a $5 million project, the effort is the same. It's the same amount of sales effort. There is nothing from a consultancy perspective that the client just buys themselves. They don't walk into the shop, take a can off the shelf and walk out with it, right? What you end up trying to do is basically realize, how do I package stuff up so I can get, when I do a sale, it's more like a $5 million sale than a $500,000 sale. That requires some thinking about the products and services you offer, but it also requires the confidence to like be able to ask those kind of prices and then have kind of the brand or the track record to justify those prices. The believability to justify the price you want to charge, which will always still be a discount to McKinsey or a Bain. But we've made loads of mistakes doing that. And then if you want to sell your consultancy business, you need to have a certain density of people and team that the acquirer wants to buy. So one of the biggest problems with us is like, if you looked at our global revenues come together, in principle, we should have sold the whole business sooner. The reason why we didn't is people go, cool, like that's an interesting number. Where are your team? Well, I've got 5 guys based in Copenhagen, like 10 guys based in Berlin, another 6 guys in London. Oh, we've got a few people in Singapore, a small team in like Miami. To a consultancy, well, like that's useless. Because also most consultancies are run geographically, and some big 4 accountancy are completely separate. Like UK KPMG is very different to like Germany KPMG and like so on, because there's a different partnership group per country. And so you really need a density of like 30 people plus with like good revenues, good profitability over 3 or 4 years to then be like a nice acquisitive target. And also they're always going to acquire you. They're not really going to acquire you for the revenues. They're going to acquire you for capabilities. If you want a good margin, you need to be offering a service that they struggle to do right now.
What can be a multiplicator for the revenue or profits for selling the consultancy business?
I mean, consultancy businesses, it's hard to get much above 4 times revenue. I mean, it varies on some of these things. I mean, there are some nuances, but like basic consulting services where you're delivering human beings or creating pitch decks or whatever, like, it's hard to get above 4 times revenue. IT-backed things that are slightly different. Certain niches which have higher multiples, but that's not corporate innovation.
What is potential margin?
You would look to make on a gross margin basis on a project, you'd want about 50% gross margin, which if you're running well will get you down to probably something like 20% net margin at the bottom if you're a well-run consultancy. What's hard though is if you don't sell consistently and there are periods where you haven't got new projects coming in and you haven't fired people immediately, the profits you made from the previous 6 months worth of work will go into keeping people on salary, not doing any paid work, and you lose all your profits. So the billability ratio is really important to stay on top of. Otherwise, you might make money and lose money really quickly. So for years, we had a really badly run business where, I can't believe I'm going to say this out loud, but it's true. Like, our revenues were like doubling or tripling every year, but our profit was the same. Year 1, profit was like 1 million, 1.5. It was like year 4, profits 1.5 million. It was like, what? That's like a really bad business. It's because we just didn't manage our cost base. Because again, we were setting up all these offices, we're going around the globe. We're having a cool lifestyle, but we weren't running a well-run consulting business. And that's because we were entrepreneurs who accidentally built a consulting business. It's not a business model I would ever build again because it sucks. It scales linearly. So, you win more projects. You have to hire more headcount to deliver the projects you've won. So it scales very linearly. It's so tied to market conditions. You have a lot of people you have to manage. And there's people problems. I don't want to work with him or her on this project because we don't get along. It's, for fuck's sake. And then, you've got someone who's like, I don't know, one of your employees, they got into a relationship together and now they're broken up and now that's a problem. It's like, oh my God, there's just like loads of people problems that come with those businesses. And they're great in some ways because They're not rocket science. You can make money from day one and you can be profitable from day one. But I think that if you don't sell them, it's hard to make good money. If you get them to scale and sell them, you can make a decent exit for sure. But just dividending money out.
Nine companies you built with corporates.
Yeah, so in my UK studio, 9 companies. Yeah.
Some of them got Series A, some seed round, some pre-seed, right?
Exactly. Yeah, exactly that.
So you said that like up to 8 million potential Series A round. What might be the exit valuation when you sell the company?
We don't know truly where it will end up, but I'll tell you this much, because a lot of people, like, one of the things we've struggled to raise money for our business is we don't follow the same power curve as traditional venture capital. So traditional startup studios are venture capital, right? Now you'll say that a startup studio, which I do believe should be more efficient, both capital efficient and effective in terms of lower failure rates than just plain vanilla VC. But it's the same asset class in the sense that 1 or 2 will get outsized returns. They'll hopefully IPO. They'll sell for $1 billion or 400 million, whatever. You're still playing the same game. Now, for us, it's different because the core of our model is based on this economic partnership or trade-off, where I say to the corporate, I want your scale strengths. I want your distribution, your logistics. Right, cool. In exchange for your scale strengths, I'm going to give you a call option, which gives you the right to acquire 100% of the business early, typically year 5. And it's an economic exchange, which allows me to contractually obligate. So I say, look, I give up my convexity. I can't ride one of the winning startups to $1 billion exit. I'm allowing you to buy us out year 5, like sort of the Series B mark. And so I'm giving up this huge convexity in exchange for that economic trade-off that I lose. I'm going to contractually obligate you to deliver those distribution. So if you don't deliver this and I've given you that, I now dilute you because it's now unfair. It also prevents me from getting into a discussion of, well, Jordan, if I'm giving you access to my 1 million customers, how much more equity should I get because I'm giving you access to my customers? I don't want to get into that discussion. It's very simple. I give you a call option. That's the trade-off.
I think it is very important detail of this partnership that like you get access to the customer base and it's completely different model than like an independent startup.
100%. And that's what it's predicated on. And so when you think about it from an asset class perspective, though, it means that we will never get an exit. I mean, probably never above 200. We plan our exit to be more like 40 to like 150 mil or 40 to 100 mil. I don't know what the average yet. It's too early to tell. But I would say our exits are going to be somewhere like 40 to 150 max. And I think the 150s will only really happen in the US. So that's kind of our exit. Now, the benefit, the difference for how we think about the maths is very simple. It's like, 1, we get way more ownership. The ownership is super capital efficient. Yes, we get a 20% stake at exit for the sweat. We also get up to 25% stake at exit if we invest, call it 5 million. Right? We put in 5 million, the corporate puts in 5 million over 3 rounds. So we've got 45% of the business for really something like a 6 million total spend.
It's easier to attract capital to this holding company.
It's really capital efficient. And then what we then go on to say is, 1, we're going to get a much higher strike rate. So we believe conservatively 1 in 3, more like 1 in 2, which is what we want to hope for. But say conservatively, 1 in 3 of everything we incorporate exits. That's significantly different odds to traditional venture because we bake in the buyer, we have these assets, there's a lot of things that we do. We design the right founders, there's a lot of things we do. So we believe we're going to get a much higher strike rate. The second thing is we're going to get a liquidity event a lot sooner. So actually it really boosts our IRRs because we're going to get a liquidity event year 4, year 5. And so when you look at those maths, it's kind of like private equity level risk, but we're doing early stage venture. Isn't this power law of 1 startup returns the entire fund and that's it, right? It's very different. That causes us problems with the types of money we can get because if I go and try and raise from a VC funder funds and I say, hey, you've got this fund, you put money into like VCs. They're like, yeah. I'm like, cool. Put some money into my studio or into my fund. And they go, yeah, cool. This looks amazing. What does it do? And then it's like, well, hold on. This lack of convexity is a problem. And it's a different set of maths, which means that their investment mandate hasn't got a clear fit. And so we sit outside of their investment mandate because we're not really venture capital, like in the purest sense. And so no fund manager is going to be like, I'm just going to deploy money outside of my investment mandate and just take a chance on you. And you end up in that chicken and the egg scenario of going, this sounds really smart, but like, have you had an exit yet? And you're like, no, not yet. It's coming. I can show you stuff that looks really good. But the other downside is the portfolio we've got. I mean, I can show you the traction levels, but I can't show you a mark-to-market event, which is actually, I didn't realize how disadvantageous that is. Because with a normal studio, if you're doing rounds in the wild, right? Like even if you do a convertible, that at some point becomes a price round. You can then mark your NAV and say, look, our net asset value on book is X million because I can fucking show you the market price. I can't do that because I've got no market price. It's us and the corporate. So it means that even though we think we've got an amazing portfolio doing really well, and I try and get money in, I can't mark to market. And because I can't mark to market, which they would still apply a discount to anyway, I don't have a high enough NAV value to give new money confidence. Because I then show them, well, this company's making X million in revenue and there's their ARR, but they're not going to take the time to like analyze each of these different startups and be like, well, what are their KPIs? What are their performance? And like create their own value, right? Mm-hmm. So without a mark to market, it's really fucked us actually. And be like, well, what are their KPIs? What are their performance? And like create their own value, right? Mm-hmm. So without a mark to market, it's really fucked us actually.
Jordan, please share your story, how you started with the corporate venture building. I listened to your podcast, probably recorded 2 years ago, but I want to hear this story on my podcast.
No, absolutely, Max. It's kind of a combination of things. So it really goes back. I was in New York and I met a guy called John Borthwick who runs a studio called BetaWorks. I was so amazed about what they were doing. And it was the first interaction I had come across around the startup studio as a business model, as a concept. And I was like, oh my God, they're not just an investor, they build stuff in-house. And they were articulating what they were doing and their vision. And I was like, this makes so much sense. This is because I'd been a founder pretty much most of my life, a founder and a CEO of various different tech startups. And then after one lucky exit, I transitioned to the investment side, initially as an angel, writing very small tickets into a handful of startups. And then more professionally as a venture partner at a global early stage VC fund. But I found the role of a traditional VC quite boring. It was a lot of watching and waiting, but also the business model is you're really an asset manager. And so, it's about fund one, fund two, increasing assets under management, really a far cry from being really hands-on and being active in with your portfolio. To be honest, very few VCs, especially in Europe, I found the role of the VC sort of not quite ticking all my boxes and not quite fulfilling. And I still had this itch of, I wanted to build stuff, I wanted to do stuff. But the benefit of being the investor was you, A, get to leverage other people's money, but B, more importantly, you get to have a portfolio. So unlike a founder where all your eggs are in one basket and the outcome is very digital. That startup either works and you make money, or it fails and you've lost years of your life and potentially a bunch of money, but definitely a lot of opportunity cost. And so I love the idea of kind of trying to get somewhere between the best of being the founder and best of being an investor. And that's where I see the startup studio model come in, where, we ideate and do that huge creative process to come up with venture concepts. Now, admittedly, we're not the ones doing the building hands-on. We hire amazing founders to do that. But it's the sort of right middle. We have the portfolio, we have the benefits that, VC has, but we have a lot of the control and the influence and the ownership stakes. That's what I became obsessed with. And so in the UK, I started a startup studio with 3 other guys, and we went about basically doing this from scratch. Put about, a couple of million of predominantly my co-founders' money in play. Spent a few years doing that. And then ultimately that studio ended up really collapsing on one venture. So we were so naive. We didn't know what we didn't know. And the reality of running a startup studio is it's super hard. From things like when do you kill ideas? How many ideas do you run in parallel? How do you allocate resources? Do you have shared resources like development and designers that work across portfolio companies, or do you really need people fully focused on one venture at a time? How do you raise money and cover the management fee, which is much higher for a venture builder than would be a traditional fund? And all of these things we were struggling with. Anyway, we went through that whole journey, made a lot of mistakes, but also learned a lot. That first studio that I did ended up really collapsing on one venture that was by far the most successful of everything we'd done. We sort of done a few things, and there was one that sort of really worked. We ended up spinning it out, and it raised a significant round in the wild with external VCs. And essentially, my co-founders in the studio fell in to be the founders of that, and they went with it. I didn't go with it because it was in the ad tech space, and it was something that I could see the investment rationale. I just wasn't passionate about it personally.
What were the years like when you went to BetaWorks, when you started studio, when your co-founders started to be focused on this one venture?
Yeah, 2010 to about 2012-ish, maybe 13. And then, 12-ish, and then probably 2 years off, and then I joined Rainmaking in 2014. So after the studio, I took a couple of years out into entrepreneurship education. So I started teaching entrepreneurship at accelerators at university and all around the world, and intentionally took a break from a VC-backed business model. I was like, I'm just going to read some books and chill out and maybe make a little bit of money. But then I really wanted to start scaling something again. And so after kind of that period in entrepreneurship education, I ended up joining Rainmaking as a late co-founder. And I met Rainmaking when I was doing my studio in London, because I set up something called a Studio Guild, which was, there's 2 or 3 studios in London at the time, a company called Makeshift. There was Ford Labs, like the original Ford Labs. There was an agency called Mint Digital that was doing some venture building and trying to figure out how they blend being an agency and a venture builder. And that's basically it. And there was us. And I got us together to kind of talk about, like, how are you doing this? How are you doing founder selection? When do you bring in founders? When do you not? Is it one founder, single founder? Like all this equity ownerships, like all of these things, you have to understand and come to a decision on in terms of your operating model, and just sharing learnings and mistakes. We did that. And in the process of doing that and being a venture builder or startup studio, I got introduced to these Danish guys called Rainmaking, who started in 2007. So they started before me, and they're like, hey, look, these guys in Denmark have been doing it. They've actually been pretty successful. You should reach out to them. So I reached out to them, and they were super kind. I basically flew out to Copenhagen. They gave me a whole day with the whole Rainmaking founders, and we, again, just shared learnings of like what worked for them, what they didn't work, how they set up their shop, what was their philosophy versus, and how has it evolved over the years they've been doing it, which was super interesting. And so that's how I met them. And then some years later, I ended up joining them as a late co-founder, and then spent predominantly a couple of years sort of building our accelerator business, started bootcamp, and somewhat by accident built a corporate innovation consulting business. When we were building Startup Bootcamp, which is really, and I'll be very honest, it was a clone of Techstars. Alex and Carsten had founded it. They'd met David Feld and Brad Cohen at Techstars in like 07, 08, like when they just had one program in Boulder. And they went out there, spent some time with them, was like, what's this accelerator thing you're doing? This looks freaking cool and awesome. You're working with founders. They were so amazing. They were like, well, this is what we do and how we do it and how we think about it. And essentially, Rainmaking then went to Brad and David and said, look, can we be like the European version of Techstars? And at the time, they said, look, we don't care about Europe, have at it. Here's our playbooks and here's how we do it. And if you want to go do it in Europe, good luck to you. And so that was the origins of Startup Bootcamp. And then as the accelerator industry grew and there was more and more competition over deal flow, Startup Bootcamp was one of the first accelerator programs to take not just an industry view, but a multi-corporate view. And it was driven by a very selfish desire. It was like, okay, if we pick industry, so we know that focused investment theses tend to outperform generalist theses. So if you have a fintech theme or insurtech, and so we picked a couple of themes, so like fintech, and so we'd have fintech London, fintech New York, fintech Singapore. We would then go to corporates and try and get multiple corporates to sponsor a program. So like fintech London was like MasterCard, Lloyds Bank, Rabobank, a few others. And it was driven for very selfish reasons. One, we knew, rightly or wrongly, that first-time founders are, at least at that time, were hugely attracted to the big shiny logos of Fortune 500s. So if we collected a bunch of big logos of banks, like MasterCard, then startups should be more attracted to our program. And the second element was the money we got from the corporates as sponsorship just was like, well, it's more OpEx, so we can run better programs, deliver more value, and therefore we should be able to attract better startups. And it was purely driven by this very selfish desire to own equity in better startups and to cut through the increasingly competitive deal flow around early stage startups as more and more accelerated programs were appearing in Europe. And so in doing that, we didn't foresee was corporates going bananas for accelerators. So this whole corporate innovation thing exploded. We ended up partnering with something like 85 Fortune 500s across maybe 20 or 30, maybe close to 30 programs around the world. And that was nuts. And then essentially, we ended up having all of these corporates tied into sort of 3-year contracts per program around the world, who then started coming to us and being like, look, this accelerator thing's fun, but it's not moving the needle on our innovation challenges and agenda. These startups are too early stage for us to do anything commercially meaningful with. Could you help us in other areas? While we were building that, I found that whole concept, the early days of corporate innovation, fascinating. I don't as a startup guy my entire life, I was like, I don't get it. You've got billions of dollars, you've got millions of customers, you've got manufacturing plants, logistics fleets, you've got all of these cool things. What are you struggling with? Why do you have a problem? I don't get it. Mm-hmm. And, as we now know, regardless of industry, all of these big corporates were struggling to maintain market position and market cap in a fast changing world. They started coming more and more to us, asking them to help. And I found the intellectual problem around corporate innovation super interesting because no one had an answer. No execs, no MBAs, no professors, no one had a playbook of if you do these 4 things, you'll get 50% of the value, or it will help. No one had anything. And so I was like, well, that's really intriguing. So ended up trying to solve that problem, which ended up us building basically a corporate innovation consulting business, because that's kind of how it panned out. It's okay, you have this challenge. Let me understand this challenge. How can we help? How can we apply an entrepreneurial mindset to that, or skill sets, or whatever, digital tools? Fast forward to where we are today, we built up a global corporate innovation consulting business called Rainmaking Innovation, really off the back of Startup Bootcamp. When we started doing that business, unintentionally, we ended up falling into our first ever corporate venture building project with Jaguar Land Rover. So we did some strategy work with them in 2014. We basically told them, or we're trying to tell them, that the future of just manufacturing metal boxes with wheels for them wasn't necessarily future-proof. And we were creating a whole strategy around look, the future might end up being fleet owners, and there'll probably be electric vehicle fleets that might become fully autonomous. And those fleet owners will probably be a Google or an Uber, but it won't be you. And if the world, especially in urban city centers, transitions to fleets, the business model is going to be much more like a Boeing or an Airbus selling to an airline. And when you sell aircraft, no one cares about the joy of driving, or if you're BMW or Jaguar Land Rover is a premium brand, the fact that when you shut the doors and the car dims blue and you've got all of that's irrelevant. No one cares about your brand. The fleet owner is going to be how cheap is it? How many can you get me? How much servicing do I do? What's the all of the unit economics of running a fleet are fundamentally different from a purchase decision than would be the case that they're in. And also, the likelihood of Jaguar Land Rover transitioning to becoming that sort of manufacturer is very slim. One, because they're actually a small manufacturer. They do about 400,000 units a year. So they don't really have the capabilities to become the Foxconn to someone else's, Apple, right? Or the Boeing. But also they hadn't done anything in electric vehicles at that time and weren't really planning on it. The execs were wow, we don't believe in electric vehicles. Anyway, this is a very long-winded way. So we did the strategy work, which basically said to them, all of these things we think are going to happen. And if any of this stuff happens, you need to diversify from your core business today. And we recommend you diversify into digital mobility. And so we're basically telling them, you have to build digital mobility startups. And they said, okay, fine. Help us do that. I was like, what do you mean? And they're like, well, you're telling us we need to do this stuff. We don't know how to do that. Follow through on the strategy work you've just done for us. And so suddenly we fell into this world in like 2015 of being like, okay, so you sure, we'll just build you some startups from scratch. And that's how we fell into this world of corporate venture building. But it was driven from our consulting business. Initially, 4 or 5 years into that experience, we'd done close to 30 venture type projects with loads of different corporates around the world. We'd made a ton of money, like predominantly in fees. But some of them were like fees plus equity, so we had equity stakes. The experience we had was bittersweet. It was sweet in the sense that we got pretty good at leveraging the scale strengths, the capabilities, and the deep domain knowledge of our corporate partners. So the manufacturing capabilities, the distribution, all of these things, which meant that when these ventures worked, they scaled quicker than anything we'd seen in the wild before. And they would reach sort of meaningful revenues, 10, 20, 30 million rev, with significantly lower capital investment because they were so capital efficient because we weren't having to buy the distribution because these corporates already had it. So that was exceptionally exciting. But the downside or the bitter side to this experience was when we looked across this portfolio of nearly 30 projects, the success rate and ultimately the return on investment across the portfolio was worse than if we were just building startups by ourselves at Rainmaking. And so we had this enigma or this quandary about, well, hold on, should we be getting better results by leveraging all of these corporate assets than not worse results? And it took us a while to figure out why we thought this was the case. And we ended up coming to the conclusion, and I can go into this in detail if you want, but came to the conclusion that, simply put, you can't successfully or systematically build successful ventures within the constraints of a consultancy business. So we ended up ripping out all of our corporate venture building activities in Europe and North America from our consulting business. We set up a new firm, a new entity, a new company called RBS, where we became an investment firm that builds startups in partnership with large corporations from scratch. So we're basically a startup studio, but specifically with a corporate twist. But we believed we'd engineered out all of the bad bits that meant that this stuff didn't work within a consulting model. Because don't get me wrong, as a consultancy, you can make a lot of fees selling venture building as a service or things like that. But ultimately, the ventures don't create enterprise value for various reasons. And so if you want to focus on enterprise value creation and you actually care about the equity stakes that you have, then you need to change the environmental conditions around that. And you can't do those changes that are required if you still operate as a fee-based consultancy. So we raised some money and we went about building this sort of new version of corporate venture building called RBS. We officially started end of 2019. We raised our first chunk of money. Yeah, so 2019, we raised really some seed capital, about 1.5 million, just on the concept of we think this model, building with corporates, is going to deliver outsized returns for these reasons. And so we took the initial 1.5, we started engaging with corporates, started working with stuff like Anglo American, DPD, a few other things like Bunzl, Morgan Stanley. And now COVID hit in 2020, which was tough for us because corporates were like, we're doing nothing. But we built enough traction that with the initial 1.5, so we then went back to investors, raised another 6 million, 6 and a bit, to continue doing what we were doing and then grow the portfolio and go from there. That's kind of how we got into it. So it's been this real world of as a founder, as an investor, wanted to do something in the middle, came across this concept of a startup studio for the first time or a company builder, became obsessed with it because it makes so much sense from capital efficiency, ownership stakes, the things that you can control. You control the founder talent. You get to get involved with the ideation. There's a lot of things which are really beneficial. And then from the studio, sort of somewhat accidentally into corporate innovation, which was completely unexpected. And then sort of combining the experience from corporate innovation consulting into sort of mixing these two worlds of having a startup studio, but with a corporate flavor. And there are some major benefits to doing that above and beyond a normal startup studio model. It has an Achilles heel, which you can't solve for, and you need a little bit of luck, which a normal startup studio doesn't have. But I can go into these details because that's when we get to geek out on why this model, why not just do another startup studio in the wild bother with corporates, How do we make it work? And yeah, I know I've been talking for a long time, so I'll stop.
To have the full picture, can you explain like how many companies have you built when you invested in startups, Rolf? So from 2019?
From our one studio, from 2019, with that initial chunk of money, we basically built 9 companies from that. There's a few other things we've done on the side, but basically a studio for us is a team of about 8 to 10 people, and they will do 3 to 5 ventures a year. So for us, during the pandemic, we launched 2, then it was 3, then 4. So I'd say 3 to 5 ventures a year is a steady state for that amount of team members. In principle, you can increase the amount of team members to increase the deal flow, or you just set up new studios which have the same team and do 3 to 4 studios.
How are you connected to Rainmaking APAC?
So Rainmaking APAC is the Asia division of our consultancy business. So Rainmaking Innovation is the consulting business. I mean, obviously I'm a shareholder in all the rainmaking stuff that we do. So Rainmaking Innovation is a consulting business that has 3 geographies: Europe, Middle East, and APAC. We sold the APAC flavor of consulting to Bain. And the reason why they bought it was very simple. They wanted venture building capabilities. But our APAC division was running venture building still with a fee-based approach or a fees plus equity approach. With RVS, when we spun out RVS, we basically created a non-compete. So in the geographies that RVS operated, our consulting business wasn't allowed to do any corporate venture building, because otherwise there'd be a conflict, right? RVS, we were focused on mainland Europe and North America, and we've had very little interest in Asia. So our consulting business still did a lot of venture building work in Asia, but also corporate innovation maturity is a few years behind, quite a few years behind North America and Europe.
You mean several years before? You mean in APAC, it is lagging in comparison with the US and Europe?
No, so like Asia in general, corporate's maturity level for innovation is probably 4 or 5 years behind the US and Europe in general. They're still doing a lot of like what we would call innovation 1.0 things. They'll do accelerator programs, startup competitions, hack all the stuff that makes no difference to corporates, but they don't know any better. So their level of innovation maturity it's behind. Now they're still operating in growth markets because they have a much better economic condition than definitely Europe's had in the last couple of years. If you're interested, I can tell you why I was never interested in going to Asia for venture building. When you look at our model, there's a couple of things we need to happen, right? From a corporate side, I need very large corporates. I need corporates with minimum $1 billion in revenues, because otherwise they can't afford to buy back our companies, right? Because the ventures we build, the explicit intention is to sell the venture, if it's successful, back to the corporates. We try and bake in the buyer from day one, which is part of the reason why we de-risk the process of building businesses in our approach. So you need very large corporates. Step 1. Step 2, in our thesis, we only invest in second or third time VC-backed founders, proven founders. And the reason why we do that is 2 reasons. 1, it drives way better investment returns than investing in unproven talent, because first-time founders know nothing. They haven't made all the mistakes before. And so when you look at those ecosystems like Asia, they are emerging startup ecosystems. So finding talent who've raised a Series A from a tier 1 VC before is really hard to find, because there aren't that many. It's not been going on that long. So the talent pool is way smaller, and you then have to assess on potential. How do you do that? Versus proven track record. And it's not just the fact that they raised Series A before. You need the diversity of founders across multiple different business models and industries for you to build what you want to build. So like if I'm building a B2B SaaS, I need someone who's done B2B sales before, right? Otherwise I can't put them into the team. If I'm building a direct to consumer business, it's brand, it's marketing, it's a very different skill set. And so you need both the depth and the breadth of founder talent to run multiple business models, and also business models in different industries. Like regulated industries are very different to unregulated industries. So fintech and insurtech is very different. So we would expect one of our co-founders to have prior industry expertise. So the talent pool is just not deep enough in those markets. The second thing we really care about is obviously the size of the prize, right? The issue with countries like Singapore's got 7 or 8 million people. So you can't do anything consumer because it's not big enough. You're left to like, can I sell? Is there a big enough business in an enterprise to like financial services or insurance, which are the 2 largest industries, to make enough money for an exit? Otherwise, if you can't make it locally, you're then saying, in order to get to a high enough EV, I have to internationalize. So you're going from Singapore into Indonesia, Malaysia, Cambodia, Thailand. That's really freaking hard because they're all different languages, they're different cultures, they're different regulations and legal systems. Like the execution risk to be able to land and expand across APAC is like super hard. Now, you would look at someone like Indonesia and you say, okay, it's got 200 million people. Maybe we should do it in Indonesia. And in principle, because of the size, great, but Indonesia is pretty corrupt. So it's like, yeah, you could go to Jakarta, but like, what's the likelihood you're going to pull something off in Jakarta? For all of those reasons, lack of talent, there are companies with big enough corporates in the region for sure, but the market dynamics of how you get to the kind of exit values we want are just increased risk. So for us, it's like ignore Asia, because also we don't believe we can be successful in China. Rainmaking has tried to operate in China for like 4 years, and we lost quite a lot of money, and then came to the conclusion we're just not capable of winning in China. Full stop. So China is out of bounds. Japan is even more esoteric, out of bounds. Like as a non-Japanese person, there's no way you're going to be successful in Japan. So you're really talking about like Singapore, Hong Kong. Now politically it's basically screwed over the last decade, and it never grew to its potential in the startup ecosystem. So like really Singapore's like the only place you'd start. But then where do you go from that? Because going from Singapore to Thailand is very different. So we've ignored Asia from an RVS perspective because we just don't think it's that interesting. Also, coming back to the maturity level of corporates, America is like the best market, full stop. The amount of corporates in terms of huge corporates, but also their culture around risk-taking, like entrepreneurial mindset, just doing stuff, spending CapEx to make big bets. And there's a huge, large addressable market in the US. Like, it's awesome. It's the best market in the world. So, and there's so much value to be had in America. For us as a European company, it'd be like, okay, if we're going to expand out of Europe, it's America. Why would I go anywhere else? So America is like the number one focus for us. Europe is our legacy and our pedigree and where our track record is. So yeah, our portfolio sits across the US, UK, France, Germany, and the Nordics, predominantly out of Denmark. If we're leaving Europe and the US, where would you go? Middle East? Too small. I mean, there's a lot of people making money in Saudi right now because of Neon, and then APAC is just too. But again, you don't have the talent. Corporates don't really understand this stuff. It's very different. And from a studio perspective, and maybe this might resonate. When we ran our first studio, so before Rainmaking and RVS, we hit this problem. You basically get to a terminal velocity and then you stop. So if you're working on, say, 4 or 5, maybe 6 ventures, you suddenly realize like your entire team is flat out just trying to work across those 4 to 6 ventures. And you can't keep scaling. You can't launch another venture unless one of them dies or one of them completely spins out and you give no more effort to it. And so it's a bit like a revolver, right? You have to shoot a bullet before you can load another one in the chamber. And so the studio we found on our first go round was just not scalable. It's like you hit this terminal velocity because the only way you can scale it is somehow by like increasing your team size. Finding the right talent is super hard. The people that have the skills to do this and do it well is really hard. But also you then need the money. So where's the money going to come from to cover, the doubling of your team size or increasing your team size? Who's going to pay for that? You have this juxtaposition where if you've got a studio going, you tend to hit this like terminal velocity where you max out. And I was really keen to try and avoid that because I wanted a more scalable model. The question then is, how do you have a model where without increasing your team size, you can keep launching ventures? And you have to rethink one of the fundamentals of most studios, which is every studio takes some sort of ownership stake, like typically 20%, right? Often they take that ownership stake for no cash. And they say, oh, we provide all this human capital. So we've got great developers, designers, we've got amazing talent, like we've got all these ex-entrepreneurs, like we're here building this business with you, we're hands-on. And because we give you all this human capital, we're going to take this 20% stake. Suddenly you have a problem because it sounds good with venture number one. Well, I don't think it sounds good at all personally, but like it sounds good with venture number one. You start maxing out, you get to 3-4 ventures or whatever it is, depending on your team size. You then struggle to deliver value consistently across your portfolio. And then the founders rightly come to you and go, dude, Jordan, you're not fucking delivering enough value and you've got a huge chunk of my company. What the fuck are you doing? And then they get pissed off. And they're right to be pissed off because you've got a huge chunk of their company and you haven't put cash in. And anyway, any cash you put in should be dealt as cash. It's fucking money. So whatever investment goes with other investors, I put my money, my euro is a euro, it gets treated like every other euro, that's the end of it. But if you're talking about the sweat component or this human capital component, you hit this issue where you basically launch a bunch and if you want to deliver high quality when no one's questioning your position on the cap table, even have a lower terminal velocity, so no one's complaining, but until one of them dies or is completely spun out, you somehow raise new money, you can't launch anymore. So you have this issue of like, it's actually not scalable. So I've experienced that firsthand in my first studio where I wanted to engineer that out. And one of the benefits of RVS is we don't get our ownership stake because we turn up with human capital. In fact, we say we give you no support. We're not doing any development. We're not giving you any support. We give you cash and we provide a corporate. That's it. And you build your startup. Which means that, yeah, we sit on the board and we go to board meetings and we take those things very seriously, but we're never contracted or expected to deliver this human capital component, which means that if we hire amazing founders who don't need much support either, and we just leave them alone to build their business, it's much more scalable. The ethos of why we choose proven founders isn't just because we believe they get better investment returns, right? It's also because we don't want to get tied up delivering support. Because whether they expect it or not, what you don't want to happen is, because most studios as well will struggle from this like flower and weed problem. They'll have a few portfolio companies that are doing really well, like the flowers. They'll have a couple, one or two that are like the weeds that are really struggling. All their resources go onto the weeds and they don't go onto the ones supporting the ones that are doing well. And what ends up happening is you get tied in trying to turn a bad business around and make it okay. Whereas if you ignored it and shut it off and put all your resources into one of the two that were doing really well, you would have got better returns, right? And it takes huge discipline to do that. It's really hard to do that when you're running a studio. But basically, I wanted us to avoid having to pitfall into that scenario where we're having to allocate too much of our resources to our portfolio. Because I know there are studios out there which will do things like, well, we take less experienced founders because we'll give them less equity. Because this is the other thing. If you take too much equity as a studio, the better founders tell you to fuck off. They're like, that's a bad deal. Why would I do that? I'm out. You have greedy studios who often don't understand the capital raising journey and what's necessary from a cap table to raise new money later down the line because they're idiots. But also they're being greedy and they're going, it's okay, we'll get someone who's going to accept a deal that no good, talented entrepreneur would accept. But then you have to acknowledge that in bringing in that sort of beginner talent, you're going to have to do a lot of the work for them because they don't know anything. So you're going to get sucked into that. There are a lot of things that we've learned over the years that we're very mindful on about how we design our studio and op model so that it's scalable, but also you don't meet these challenges.
Key thoughts and ideas. So first, when you build with corporates, it's much better to have skin in the game to make viable companies than just do a service business or consultancy business. Second, partnering with corporations, co-investing makes it easier to agree with them and so to show them that you understand what you're doing and you believe in it. It's easier to get their money also so that you are a co-lead investor and the second investor. The third is it's very beneficial when you have access to their customer base and to promotion channel. You ask this, because you don't have ability to sell company for $1 billion, but at the same time you have planned acquisition in 5 years if everything goes right. You earn very good equity, very good maths in this holding company, because you get very cheap, you got this 20% and also you have fund.
That's a good summary. I think what I would say about this whole thing, right, is when we started this process, it was how do we build a studio that we thought was truly scalable, had the best benefits of being from a corporate and the best parts of the startup world. And so how do we fundamentally de-risk the process of building startups? Which is what every studio tries to do. You try and get better than market average, right? Results. When you try and do that, our view was basically saying, in partnering with large corporates, baking in the buyer from day one, contractualing their scale strengths, their assets, their distribution, putting in amazing founders, all of these things should deliver us better results, capital efficiency. So all of these things is kind of what we've done. And it's true. What I would say is we've been doing this a long time, and all the benefits that the corporates bring, they are also the biggest enemy or the biggest weakness. There's this weird thing. Large corporates are actually, in truth, irrational investors. So they will do dumb shit that is not in their interest because of politics, because of someone's career path, because of something else. Nothing we can do to engineer that risk out. So we build businesses that are kind of so interconnected to the corporate, literally designed to be connected, to get the benefits. But then a 4 or 5 year period is such a long period of time for a corporate. What's the chance that CEO is going to change, other key stakeholders change and leave the business, strategy changes, and at any moment, they just decide, like, for whatever reason, we're just not interested in this anymore. They'll write, doesn't matter how much money they put in it, it's still a rounding error. They're like, yeah, 20 million, fuck it, gone, boom, that's last year's budget. It's over, like, who cares, move on. And they'll just shut stuff down or they'll behave irrationally. So we've seen, and we've had, painfully, amazing businesses that were doing, like, the definition of success. Like, revenue, profitability, growth, like 40% month on month, even to the point where they had, over 100 employees in the startups team, big, mature, post-Series A businesses. Overnight, new CEO comes in, yeah, we're not interested in this anymore. This thing is worth so much money. Like, it's not even something I just point you to their revenue. What are you doing? And they're like, yeah, I'm not interested. The biggest strength to our model is also our biggest weakness. And the thing that keeps me awake at night is the corporate irrationality, how much of that is an effect to our failure rate across the portfolio. Is it 5%? Is it 20%? At some point, it's going to screw our model. And I don't know yet where we are on that dial of something we cannot control. And so that's the hardest part. But when it comes to corporate venture building, I'll tell you this much. I think you can make a lot of money as a consulting business, but none of the ventures you build will work. You can make money for your business, but the projects and the stuff you do will never make any real money. Mm-hmm. But you don't care because you're a consultant. But I genuinely don't believe if you're running a consulting model, don't worry about equity. Take your fee, do what the corporate asks you to do. Doesn't matter how dumb it is, take your fee and move on. If you want the ventures to actually create real meaningful enterprise value consistently across a portfolio of bets, not just one lucky example, but consistently and repeatedly, you cannot do that as a consultant. It will not work.
I remember some additional thoughts from this interview. So fourth is that you cannot understand are you doing good or bad because you cannot compare yourself to the market benchmarks. Then fifth, rely on the second-time founders who are getting like 30% at exit the team of the startup whenever their valuation and rounds of investments are. Then six, Asia is very difficult to do venture building. And then I have a question for you. I hear this from the previous 2 years old interview. So you mentioned some figures. Only 8% of venture builders, of corporations create successful companies. It takes 4 times. I don't remember what was there, but yeah, what is the statistics and what is the source? So can you repeat it?
No, I could dig out the source for you. Basically, regardless of industry, when corporates try to build a new company themselves, like a new venture, So a new to them business model, not a new, like it's a new to them business model. So building a new venture, their success rate is 8%. So 92% fail. And of the 8% that do succeed, they typically take twice as long than an equivalent startup to reach any kind of scale and 4 times the investment capital than a startup would. It's doing the same thing in the wild, which is nuts. But also, the soft elements is that those 8% that do succeed only succeed because of an unrepeatable hero effort from either the CEO, who's of the group, just pushing this venture through the business and just forcing it through, or the CEO of the venture itself, who's got a lot of political capital, who's literally spending their blood, sweat, and tears and calling in every favor to force that business to a success. And those things aren't repeatable. So, like, they can do it once, but the odds are really against them, and it comes down to the basics.
It is some external statistics and data.
Yeah, this is external data, so I can dig out and show you the article. But like it's true from everything we've seen as well, across our consulting business and at Rainmaking in our venture building stuff. And it's very basic. It's like corporates don't have the right incentives. So when they try and do this internally, they won't give people equity from day one. They won't put people on low base salaries. They won't you get entrepreneurs, you get employees whose salaries, pension, medical don't change, and they get to play at being an entrepreneur without any risk. That's it's terrible because, great for them because they've got a better Monday to Friday, but terrible for results because A, they have no idea what they're doing, but B, they've got not the right incentives, and the wrong incentives deliver the wrong outcomes. So never the right incentives. So typically it's employees with the same remuneration structures. 2, they use the wrong talent. So they take people from the business to do it instead of actual entrepreneurs or people who are entrepreneurially minded. 3, they have completely the wrong governance. So the decision making around how this business operates is corporate governance, not startup governance. They don't give the team the autonomy and the passion to build their team, to go in their way. The governance is fucked. And then finally, it's the funding. So they fund it badly. Even with normal startups in the wild, and there's some data on this, if you give founders too much money too soon, you increase the likelihood of them failing. If you don't give them enough money at that stage, they can't prove enough traction to get out of the gray zone of, is it a zombie business? Is it okay? Or is it definitely dead? So you have to fund it in the right way, which is the right quantums of money at the right time, but also without any predetermined KPIs. Corporates are obsessed. I don't know why. They'll go okay, cool. I'm going to give you some money now, but you're going to do a Series A round in 12 months. What KPIs do you need to hit for me to give you the Series A? And tell me now how much the Series A is going to be and what KPIs would need to be hit for me to give you that amount of money. That's so fundamentally stupid. Imagine VCs don't do this. Imagine in a VC being so VCs do the opposite. They go, you're raising money, how much are you raising? And the founder goes, I'm raising, 1 million. And they go, cool. I look at your track record and your team and all this kind of stuff. And then I go, yeah, I think you're a good investment. I give you the money. When you run out, you come back to us and to new investors trying to raise more money. And I look at what you've done and where you want to go. And I think, do I give you more money or not? Period. What I don't do is from the point of most ignorance, which is a year earlier, go, what will success look like 12 months down the line? And how much will you need 12 months down the line? And when you hit these KPIs and only these KPIs, I will then give you that. It's madness. It's madness. But corporates love fucking doing that. So they fund it wrong. They've got the wrong governance. They use the wrong talent. They have the wrong incentives. And also, if they try and build these things too close to things in their business, often the core business will react to try and kill it. If it's vaguely competitive or it's vaguely drawing on resources, politics gets it. Anyway, so you can't do this stuff. So if I'm very honest, if a corporate wants to build a new to them business model, then I genuinely believe their best chance of doing that is with someone like an RVS, not a consultancy. I still have, if I'm honest, a few more years to go to see how successful our asset class is. Because, like I said, my biggest fear is not about what we can do and what's going well today. It's the uncontrollable, irrational investor behavior that comes from a big corporate. And will that fundamentally kill too much of our portfolio for the wrong reasons or not? And I don't know. But that's what keeps me awake at night.
Seventh idea is corporates cannot build companies inside. They do it very badly. And the eighth idea is this corporate venture building model might have risks that like you are dependent on the corporate, and one night they can wake up and say we are closing this company. Will not invest more. Super, Jordan.
Thanks, Max.
Great. Many insights. I loved it very much, really. Maybe you want to say something. Maybe I interrupted you.
No, I'm good.
Great.